What is up, y'all? It's Tony. Welcome back to another video. In today's video, we're going to be talking about 2024 and my predictions for 2024. Now, I don't have a crystal ball. This is all just my guesstimate based on data that I've studied and my own opinion. So getting into 2024, today is January 1st that I'm recording this. 2023 was an interesting year. As far as my sales job, I've definitely noticed that my clients are reeling from this downturn. So I support retail, real estate, QSR, and manufacturing clients here in Texas in the DFW market, which is one of the largest markets, one of the best economies in the United States. And we have some big time clients out here. I won't name them just because it's confidential, but a lot of them are, one of them's in the single family rental space. One of them is a commercial real estate brokerage. Another is a commercial property management company. And these are my conversations that I've had with them. And across the board, they have bad outlooks going into 2024 and going into 2025. Things in the commercial side is probably the worst, just with, vacancies and, companies that are, have basically gone fully remote. It's just they're not occupying these office spaces, and people don't want to buy these commercial-backed securities, as y'all probably have read about. So it's gonna be an interesting year next year, especially because commercial relies on a lot of variable rates, and with rates elevated, and things coming due, these companies are gonna have to refinance, or these developers are gonna have to refinance into a higher rate environment, which is not ideal. Which is why they're calling for these rate cuts. You'll see a lot of real estate industry people calling for these rate cuts because they built their business model on a low rate environment, but that is just not sustainable because inflation just goes through the roof. And I think homeowners this next year are going to realize that a lot of those gains that they got in 2020 through 2022 were fake gains. Of course, if they cashed out, yes, they could have made good money, but the reason property values went up so much is because of inflation. We had so much inflation. The Federal Reserve was pumping so much money into the economy that it pushed everything up, and so it became an everything bubble. Now, the thing with bubbles is they always pop, and so the fact that it's not just real estate. We have a stock bubble, a real estate bubble. What else do we have a bubble of? I mean, name something. You could name something else, and there's plenty of bubbles that are happening. And what happens when rates are increased is that the velocity of money, how fast money moves throughout the economy, slows down significantly. So people are not investing. And when you build your business model based on an environment, a low rate environment, you're expecting that money's just going to keep flowing. It's just going to keep flowing. But then when it stops, you are basically, when the tide comes out, you are swimming naked. You are screwed. So that's what a lot of businesses did. And so you're going to see a lot of those businesses fail in 2024. You're going to see some banks fail, like SVB, Silicon Valley Bank. They basically got a 1-year note last year in 2023 where the Fed basically bailed them out for a year, but that's going to come due again in March. They're not going to make it. They're going to fail, along with a couple other banks. I mean, even Bank of America doesn't look very good right now. So we'll see what happens. Again, these are my opinions, but that'll be interesting. I think just across the board, you're going to see consumer sentiment kind of go down as we get into end of Q1. You'll see those Black Friday numbers. I know my retail companies didn't do very well. One of mine's a luxury retailer. They said they did well, but the other one's not great. Now, certain industries have done well. I mean, IT in general has done well with AI, I would say. That's been a big topic of conversation with my clients. But that's not good for the job market because IT folks, their jobs are getting replaced, a lot of them. AI can do so much. It's incredible. And a lot of companies are talking about it, especially on the kind of help desk, customer support side. Moving to a chatbot just, would take so many people's jobs because that's where a lot of entry-level IT folks start. and they work their way up to these higher roles. And so they're basically going to be cutting out that bottom. And it is a lot of IT spend that goes to that. And I don't know, companies are moving away from that stuff. As far as my manufacturing clients, they're also looking at AI and some robots and automation and stuff like that. So it's going to be interesting. It's going to take some jobs. And as jobs go down, you're going to start to see that people cannot afford their properties, even with these low rates that they're locked in on, that they have the golden handcuffs on. When they lose their job, they're screwed either way. You see in 2007, you see in 2008, people that got foreclosed on actually had high equity as well. But it doesn't matter, because even if you have 100% equity of your home, you still have to pay property taxes. You still have to pay insurance. You still have to maintain the property. And if you don't have a job and you have no money coming in, you get foreclosed on, because you can get foreclosed on for tax liens if you haven't paid your taxes. You can get foreclosed on for, what else? There's multiple ways that you get foreclosed on. Not paying your HOA, they can foreclose on you. So, people might see that, ticking up this next year, especially because of the forbearance that we've had during 2020. People are way underwater. And the thing is when you're getting foreclosed on, you just stop maintaining the property. You stop even trying to catch up on payments, because you know that your time's running out. And so people are going to see that soon in certain markets. So this is similar to what happened in 2007, 2008, and again, I was very young in 2007, 2008. I don't know firsthand, but from my research and the books that I've read, it looked very similar, where it was a slight slowdown in 2007 to a full-blown crash in 2008. Now, I think we're moving into a similar 2007 situation in 2024, where you start to see some of the wreckage, but I don't think it's really gonna hit until 2025, especially with it being an election year and the Fed kind of manipulating rates to help that. Because you got to think, these Fed officials are elected as well, so they, and they rely on the president as well. They say that they're a separate entity and they're not political at all, but they are. They absolutely are. There's a lot of money moving around. Let's just say this system is corrupt. It's not a perfect system, and so it might have an impact on this year. So that's kind of my thoughts on this year. I think we'll see some more of what we saw in 2023, but on a larger scale. I think sentiment will go down a little bit, but I don't say all this to be negative, because if you're prepared for a crash, that is the best opportunity to make money. You see Warren Buffett just pulled out $24 billion of stocks he sold off, because he needs cash. He wants to go in when this market crashes, when the real estate crashes, when the stocks crash, go in and buy up as much as he can. One of the mass statements around making money is buy low, sell high. So this is a perfect example. You want to buy these assets low and have them appreciate as well as cash flow, so you can make money. People saying, with real estate, it's time in the market, not timing the market. You got to time the market some too, because if you buy at the height of the market, you're going to be waiting probably 15 years before you actually get to that level again, where you aren't underwater. So it's all a lie. That is BS. We do time the market to an extent. So anyways, that's kind of today's video. That's my thoughts. Leave down in the comments below what you think. And I will talk to you next week. See y'all.